Have you ever really wondered what makes currencies go up and down? Well, it all kicks off with a pretty simple investment question. But the answer? That's going to take us on a journey right into the heart of global finance. So let's set the scene. Imagine you've got $1,000 and you want to invest it for just 1 year. You've got it down to two choices, a bank deposit here in the US or one over in Europe. Now, at first glance, this looks like a complete no-brainer, right? I mean, 10% in the US versus only 5% in Europe. You'd think the US deposit is the slam dunk. But, and this is a big but, when you're investing across borders, the interest rate you see is only the first chapter of a much bigger story. To really figure out which is the smarter move, we need to kind of peel back the layers of the foreign exchange market. We're going to walk through these 5 key ideas to really get what powerful forces are at play here. Okay, first step, this is a global investment choice. We're not just comparing two numbers on a spreadsheet. We're actually navigating the constantly shifting tidal currents of global currencies. So, before we can even begin to calculate our potential profit, we have got to get our heads around the single most important price in all of international finance. Let's talk about the price of money itself. An exchange rate is, pretty simply, the price of one currency in terms of another. You can think of it as the universal translator for money. It's what lets us compare the cost of, say, a sweater in London to a pair of jeans in New York. Without it, global trade just wouldn't work. For example, let's say you see a sweater in London and it costs £50. If the exchange rate is $1.50 per pound, you just do the math, and that sweater cost you 75 US dollars. Easy enough, right? But here's the thing. These rates are always moving. So what happens if the pound depreciates, meaning its value falls against the dollar, down to $1.25? All of a sudden, that exact same sweater only costs you $62.50. So when a country's currency depreciates, its stuff gets cheaper for everybody else. And of course, the opposite is true too. If the pound appreciates, if it gets stronger and climbs to $1.75, the price of that sweater for an American jumps to $87.50. So an appreciation makes that country's goods more expensive for people abroad. So here's the key takeaway. Exchange rates directly change the relative prices of things. As you can see right here in this table, as the pound gets stronger, it suddenly takes more and more pairs of American jeans to buy that one British sweater. This is the fundamental economic force that shapes what countries buy and sell from each other. All right, now that we've got that under our belt, let's get back to our original problem. We're going to calculate the real return, and you're about to see why it's not as simple as just looking at interest rates. Okay, let's just follow the money here. First, you convert your dollars into euros. Then you earn your 5% interest on those euros. But now, and this is the absolute key step, you have to convert it back to dollars at the rate you expect it to be a year from now. If you think the euro is going to get stronger, your total profit just explodes. In this case, you'd end up with an 11% return. That's more than double the interest rate they advertised. And what's so cool about this is that it all boils down to a pretty simple but really powerful rule. Your total return on a foreign investment is the foreign interest rate plus the expected change in the currency's value. It's that second part, that potential currency gain or loss, that makes international investing so incredibly dynamic. And this brings us to the big aha moment, the core mechanism of the entire foreign exchange market. It's the market's balancing act. How does it stop one currency from just always being the better deal? So imagine a scenario like this. The total expected return on euro deposits is 14%, but US deposits are only paying 10%. I mean, that's basically free money just sitting there on the table. It's a huge glaring opportunity for profit. So what would you do? What would every investor on the planet do? They'd all rush to sell their dollars and buy those higher-yielding euros to grab that extra 4% return. Of course they would. But here's where the magic happens. This massive, coordinated action creates an incredible, instantaneous effect. All that demand for euros and selling of dollars causes the dollar to depreciate, and it happens right now. In the blink of an eye, the price changes because everyone is chasing the exact same opportunity at the exact same time. And this just brilliantly illustrates the market's elegant, self-correcting power. See, as the dollar gets weaker today, there's less room for it to weaken in the future. This lowers the expected return on those euro deposits until, poof, the returns are equal again. the market finds its balance. This equilibrium state has a name, the interest parity condition. Okay, so we know the market is always trying to find this perfect balance. But what happens when you throw a wrench in the works? In this last part, let's look at what happens when something new comes along and knocks the whole system out of whack. All right, let's play this out. First up, what happens if, say, the US Federal Reserve suddenly hikes interest rates? Well, all of a sudden, dollar deposits offer a better yield. And the market's reaction? It's immediate. Investors flood into dollars, which causes the dollar to appreciate, to get stronger, until those expected returns are back in balance. All other things being equal, higher interest rates strengthen a currency. Okay, scenario number 2. What if interest rates don't change at all, but investors just start to believe, they just expect that the euro is going to be a lot stronger a year from now? What does the power of pure expectation do? This is where it gets really wild. If everyone expects the euro to be worth more in a year, the potential return on holding euros shoots way up. So to get back to that parity, to get back to balance, the dollar has to depreciate against the euro today. The market literally pulls the future into the present. It prices in tomorrow's expectations today. So what's the big picture here? At their core, exchange rates are asset prices. They are constantly moving, constantly adjusting to new information about interest rates, and, maybe more importantly, our collective best guess about the future. Now, in the real world, things get messy. You have factors like risk that can lead to some pretty wild strategies, like the carry trade. That's when you borrow money in a country with low interest rates to go invest in a country with high rates. It can be insanely profitable, but it can also blow up spectacularly. And that leaves us with this one last, fascinating puzzle. We've just laid out a market that seems incredibly efficient, almost like a perfect self-correcting machine. So, if that's true, why is currency trading a massive, multi-trillion-dollar-a-day industry? I think it tells you that beyond the clean logic and the models, the real world of risk, timing, and raw human psychology is where all the action really is.